In this video, I'm going to be sharing with you 7 easy steps that you can take to start investing today. Hey guys, welcome back to my channel. My name is Adrienne. I'm currently studying to become a certified financial planner, and I post videos every Monday on all things investing and personal finance so that you can steward your money well. So if that's something you're interested in, definitely go ahead and subscribe down below for more videos like this. And with that said, let's jump into the video. The first step would be to make sure you have an emergency fund saved. So an emergency fund would be a rainy day fund that has 3 to 6 months worth of money for your main expenses, the expenses that you absolutely cannot live without, the expenses that you have to pay even if you stop making money. So things like your rent or your mortgage or your electricity or food on the table or gas to get places, the basic expenses that you have that you need to be paying for. So having this money is important before you start investing, because if you are investing, let's say instead of having your emergency fund funded, you instead invested that money in the market. If you were in a situation where you needed to access that money because you lost your job or something happened, like your car broke down or you had to replace your tires or something, if all of that money is in the market, if it's invested and for some reason at that time that you needed it, the market is down, you're going to be pulling out at a time when you absolutely need the money, but when the market isn't doing as well. So the market fluctuates. That's not a bad thing, and that's not something that is unexpected. However, having your emergency fund in place and saved in an account where you can access it quickly is very important. So I made an entire video on where you should be saving your emergency fund. So if you want to check that out, I will put it up in a card for you to check out. The second step would be to make sure all of your, what I call bad debts, are paid off. So for me, the definition of bad debt is any sort of debt that has a very, very high interest rate. So for example, that would be credit cards. And my definition of good debt is debt that you are leveraging so that you can build wealth by investing that money in other places. So you can have a low interest rate on a car or a mortgage. Those interest rates tend to be, in my opinion, good interest rates. And the reason for this is because the return on your investment for paying off the debts that have very high interest is going to be much higher paying off your debts that are of high interest than if you were to invest it. Because let's say the market on average goes up 10% every year. If you have credit card debt that has 17, 18, 23+% interest on it, your money is going to be worth more paying off that high interest rate, because that interest rate is higher than what you would make in the stock market. And I made an entire video on how to pay off your debt, the best way to pay off your debt for your personality, your lifestyle. If you want to check that out, I will link it up in a card above and down in the description bar so that you can create a plan to pay off your debt. Okay, the third step would be to open an investment account. So finally, we're getting to actually investing. So opening an investment account can look very different to everybody. You can utilize a company sponsored retirement plan. So that would be like a 401k or a 403b or a TSP if you live in the United States, or you can take advantage of an IRA, either a Roth IRA or a traditional IRA, which you can open up on your own through a brokerage account like Fidelity. One of the good things about utilizing a company sponsored retirement plan is that a lot of times companies will match a certain percentage of what you contribute to your plan. Ideally, you would want to save 15% of your income to invest for retirement, and anything above that, you can honestly save for really whatever you want. If you're looking to save for a home, you can save for a home. If you want to save more for retirement because you want to retire early, you can do that. I did make an entire video about which accounts are best depending on where you're at in your life. The reason why contributing to your employer sponsored retirement plan up to the match is because you are 100% getting your return back from the money that you put in. So if you want to go check out that video, I will link it up in a card above and down in the description bar. Through previous employers, I've had a Roth 403b, I've had a Roth 401k, I also have a Roth IRA through Fidelity. I also have a normal brokerage account through Fidelity. My Roth 401k, my Roth 403b, and my Roth IRA, those are all retirement plans. All three of those are more tax efficient because there are stipulations around taking out that money. I can really only access that money without penalties when I'm in retirement, as opposed to my brokerage account where I can access that money pretty much whenever I want. It's much more liquid. And I personally use Fidelity for my brokerage account and my Roth IRA. That's personally what I use. There are several brokerage firms out there. The fourth step I would tell you to do is to start researching where you want to invest your money. I think this may be one of the most intimidating parts of investing because because I don't know why, but I think the finance world makes it much more difficult than it needs to be, really, for any average investor, especially anybody who's beginning or a beginner or just looking to start investing. The best place is to start with index funds. That is what Warren Buffett, who is arguably one of the best investors alive, he says index funds are for everybody the best place to be invested because it's pretty much impossible to be able to time the market. I would strongly encourage you to start researching index funds, which index funds you want to be invested in. There are hundreds and thousands of kinds of index funds. There are index funds that are the entire stock market. They are indexed. There are some that are for a specific sector. I actually did an entire video. It was probably one of my most requested videos on how to research index funds, and I put a lot of effort into that video just to make sure that you guys had the best information so that you can inform yourself and be educated in where you're putting your money, because that's one of the most important things, and one of the things I most advocate for is for people to know where their money is. First thing that you should be considering when you are purchasing an index fund is the company size and the classification. And so I would strongly encourage you to go check out that video. I will link it in a card above and down in the description bar. I walk you through the entire process of what to look for in an index fund, how to research it, what numbers to look at, or at least which numbers are important for you to know when you are purchasing an index fund. I've also done several videos on my own portfolio that can help give you an idea of what is out there in terms of index funds. Majority of my portfolio is index funds. The fifth step is to start saving small amounts every month and putting that aside and investing that money. In my opinion, consistency is always better than perfection. My gym has a quote on their whiteboard this week. It said something along the lines of, you don't need to be extreme, you just need to be consistent. And the same thing goes for saving your money. It is super easy to just put a bunch of money in 1 month and then forget about it. And the reason I say that is because investing and saving your money is something that needs to be sustainable for you. Like, for example, somebody who wants to start running doesn't go out and just run a marathon. They start little by little. They work their way up to the marathon. The same thing goes for investing. Just starting little by little, especially if you're just getting started, it can be very intimidating to just put a whole bunch of money in something that you don't exactly understand. There's actually two different ways of investing. One method is kind of that little by little mentality of putting $50 or $100 away every month. And then the other is a lump sum investing. So just putting a large amount of money one time and letting that grow on its own. Mathematically, it's actually been studied that lump sum investing yields higher returns. However, investing is such an emotional thing. I don't think that's something that people talk about. I'm actually reading a book right now that's really on the psychology of investing and how the world sees money and how we make decisions with our money based on our psychology. It's a really interesting book. It's called The Most Important Thing. But for a beginner investor, investing a little by little allows you to have more cash on hand. It takes a lot of the intimidation out of investing. Honestly, just getting used to investing your money and getting comfortable with the stock market and informing yourself as time goes on, like watching not just my videos, but informing yourself with other people's videos or reading, that can really help your education and understanding of investing. And if you are interested, I have a few videos that may be helpful. I have one on creating a budget, or how I track my expenses and how I create my budget. If you want to check that out to figure out a budget for yourself so that you can start putting money away to invest, I will link that also in a card above and down in the description bar. The sixth step would be to create a diversified portfolio, especially for any beginner. That can sound extremely intimidating. As I've said a few times in this video, creating a diversified portfolio is the best way to mitigate any risk to your money. So my rule of thumb is always to not have more than 10% of my portfolio be in any one thing. Honestly, even just one sector. So 10% of my money I try to never have in like just tech or just healthcare. And really this step is going to be the step that is most personalized to you, because a diversified portfolio looks completely different to everybody. It really comes down to the fact that you need to be comfortable with what you are invested in. What you are comfortable investing in is kind of an idea of what your risk level is, and everybody is going to have a different risk level. And that is the reason why I'm always super hesitant to ever recommend a stock or index fund to anybody, whether it's online or in person, unless I know you very well. I really can only speak speak to my experience with my money. And although I have done a lot of things with my money, I don't know everything and I don't know each person individually. However, I always highly recommend, especially for beginners, investing in index funds. And the reason for that is index funds offer instant diversification. So you're automatically not having more than 10% of your money in any one thing unless you are invested in an index fund that is specific to one sector. Index funds also have low fees. So the difference between index funds and mutual funds are that mutual funds are actively managed, meaning that somebody is managing the companies that are within a fund, whereas an index fund, nobody's actively managing it. There's typically a lot lower fees in an index fund than a mutual fund. I need to insert this clip that I took for another video, but it's really good explanation from my dad of why index funds are good or what to look for when you're getting an index fund.
What are you supposed to look for in an index fund?
What is it? Index tracking. I'd look at the specific stocks to make sure I was okay with them. And then of course the cost. Funds are supposed to be, or ETFs or whatever, are supposed to be cheap. Because they're not supposed to trade other than, you know, when people redeem. And if it's a bigger one, they can be more efficient because what they'll do is, rather than go through a broker, they can trade amongst the people that are buying and selling them. So they don't actually have to sell the stock, but they have to monitor it and get it and balance it.
Another thing about index funds is they take the guesswork out of investing because nobody can 100% correctly predict the market 100% of the time. It is actually impossible. One of the books that I like to talk about is a book called The Solomon Portfolio. I will link it down below. It takes a verse in the Bible. It's in Ecclesiastes 3. It's Ecclesiastes 11:2. It says, invest in 7 ventures, yes, in 8. You do not know what disaster may come upon the land. But the book basically talks about that specific verse and what places to invest in based on that verse. It's a really interesting book and I really recommend it for a beginner, whether you are a Christian or not. And the 7th step is to trust the process. I've talked to several of you guys just kind of about your fears with investing, and I 100% understand where you're coming from, especially if it's something that you aren't familiar with or you didn't grow up with. It can be something that's very intimidating, especially with something as important as your money. One thing I will say is without investing your money, you are actually losing money because every year inflation happens. We're losing 3% on every dollar that we have. If we're not investing that in something where we can gain more than 3%, we are losing money just by holding on to our money. Looking over the last 20-40 years of the stock market, it has historically always gone up, and that is the total stock market. The total stock market has always gone up. That is a lot easier said than done to trust the process with your money. There's really almost no other way to do it. In order to have enough money in retirement, you really have to invest. If you really want to save money for your kids' college, you have to invest your money. If you are just starting to invest, those are my 7 steps to get you started today. Let me know down in the comments if you have started investing already. If you are new to investing, let me know down in the comments below. I'd love to hear from you. And if you liked this video, go ahead and hit the subscribe button below. And thank you guys for watching, and I will catch you guys next week. Bye guys. There's an airplane right now. I just spit. I'm about to sneeze. I can't sit straight.